Hi everyone, this is Sandeep Anand. 2020 has been a really challenging year for the whole world in many ways. It has been even more challenging for us investors because the markets went through really tumultuous gyrations, which were really unpredictable. World economies came to a halt. There were millions of businesses that were lost. There were jobs that were lost. And we went through one of the worst recessionary period ever and after Great Depression. Now, we were really navigating through uncharted territories. And the interesting part is economies are still recovering out of this, but the stock markets had a V-shaped recovery in 2020. Many investors who stayed through the course had one of the best returns in 2020 because there's a raging bull market out there. We can see when IPOs are doubling and tripling on the day of opening, there are SPACs loaded in the market. There is all around irrational exuberance, and which we can clearly see. Now, 2020 also was a year of inflection for many industries and businesses because everything shifted from physical to digital. Whether we take real estate, whether we take retail, food, groceries, currency, including education, corporate meetings, everything has got shifted digital. And because of that, there were tailwinds for many industries. But at the same time, there were many lessons an investor could learn from the year 2020. But I have distilled four of them from my experience. So let's go through those four lessons that we can learn. So, lesson number one, make your investments less dependent on market led factors and more dependent on the company's fundamentals. That includes growth, earnings, and multiple other ratios and factors. So, we all know stock price is a factor of two components: sentiment times earnings per share. A very simple concept. It's a function of sentiment is nothing but the price to sales or price to earnings, as the case be, which is dependent on the market conditions, market driven. And earnings per share, we all know it's EPS or even sales growth for that matter for some of the firms. Now, what we need to focus on these two components is to focus on the sales growth or earnings growth, and not too much make it too much dependent on the market driven re-rating or derating, which is the ratio of price to sales or price to earnings. And to achieve this, we need to invest where the total addressable market itself is growing fast. And examples of such investments in 2020, we saw many, plenty. And the first one was cloud transformation. Entire cloud industry transformation was itself is growing at 18-20% overall. The leaders are bound to grow even faster, and the transformation is just halfway through, maybe not even halfway through, and still a long way to go. So the industry tailwind plus great businesses in the segment will grow even faster. So we saw how cloud companies stocks returned an average of 50 percentage, sometimes even 100% in 2020. Another example is media shifting from cables and broadcasting to TV streaming. Very obvious theme playing out, which started in, say, 2018-19, and the leaders in this segment is growing approximately at 40% plus. And we can see similar growth runway ahead. So if we invest in these companies, the sales or earnings are growing well, we can foresee a growth potential ahead. We insulate our portfolio to a great extent from the market driven gyrations. Even if the market falls, these stocks tends to fall less, and the earnings should be of quality earnings. That is important. There are many aspects to check for that. And another lesson, beware of the entry price when purchasing such growth stocks. If you go ahead and pick or invest at the peak of price to sales or price to earnings, the price correction and time correction can go on for a long time. The returns will be mediocre. Now, with this example, let me also tell you, like, we created SAN 24 2030 portfolio, model portfolio in like December 2019 last year. And we published it in January with identifying the model portfolio was aimed to identify 20 businesses for the next decade, like till 2030. The key focus was to look for a long runway of growth for these companies. And it was a difficult exercise to identify these 20 stocks that spanned across industries, across geographies, across size of the companies, across sectors, and all of that. So we created a diversified portfolio, and it was a little risk averse. And SAN 20 for 2030 YTD returns, I'm happy to announce, was around 120 percentage from Jan 1st till December 5th against 35 percentage returns of Nasdaq. So we outbid Nasdaq returns by almost a factor of three. Now, the key portfolio performers were Jumia Tech 5.7 times. That's the e-commerce play in Africa and payments play as well. Tesla, we all know the story. Trade Desk 3.2 times, which was in the media streaming business. Pinduoduo, the Chinese e-commerce giant, it becoming a giant rather. Shopify, we all know what happened for the last 2.6 times. CRISPR, the gene editing 2.4 times. Mercado Libre, the Brazilian and South American Latam fintech, as well as e-commerce, and Nvidia, the leader in gaming and processing unit for cloud transformation. So these were few examples. These are 20 stocks. Some of them underperformed, some of them outperformed by a lot scale. But the idea was when I created this portfolio for 2030, the aim was to look at businesses which will run till that point of time. But many themes played out early, which I seldom knew when this was created in January 2020. And many of these themes played out and got priced way ahead of the earnings. So it's currently pricing, all these stocks are pricing at least 4 5 years ahead, and so it's not a right time probably to enter for a very significant outperformance because they are already pricing. So the market driven factor, which is the price to sales and or earnings, is way too high at this current juncture. So but earnings will continue to compound. So that is a whole lesson that we could take from san 20 for 2030 portfolio. Lesson number two, we really cannot predict recession or market crash. So always keep, it's a good idea to keep 10% cash for our portfolio, which could be deployed when there is market crash. Why I'm saying that? You could look at when this market crashed in March 2020, most of the stocks got battered. I mean, it was like 40 50% fall. But if you had some cash, look at these two examples. I mean, Square, which is a fintech leader here, and Roku, which is a leader in the TV streaming, both of them from the point to point, like at the fall of March 23rd, the bottom price, it was 40 square and per share, and now it is 217. It's up 5.5 times approximately. And Roku is up around 3.6 times. It was trading at $90 and now it's 320. So it's always a good idea to keep some cash which can be deployed whenever there is a market correction. Lesson number three, do not put the cash you need near term in market, since the crash can happen anytime. We didn't know that it's going to crash so much in Jan or Feb, and had a Fed hadn't acted, and the themes wouldn't have played out the way it is, the correction could have gone longer, but things changed a different way. But never put the cash that we need in the near term in markets. Markets can correct anytime, and emergency funds should always be maintained. And examples are like the money you need for children's college, say probably in the next 1 year or two, or a marriage planned, or for near-term house repairs, whatever the case is, or a medical expense planned. Those should not be put in the markets because whatever expected near term, you might not end up and you will have to sell at a loss, right? So that's the whole idea. Lesson number four, do not sell out on panic when the market crashes. Good classic example we saw in March 2020, where the best of the best investors threw the towel when the market crashed. An average portfolio fell down by 30 to 40% precipitously. I mean, it was like in a matter of few trading sessions, a couple of days, it was down 40%. There was no time to act for investors. There is no time to react. And there was all around panic. Naysayers came, they will come on TV and give doomsday prophecies. I mean, all sort of negative news will be flowing on the TV, and there were many experts stating that the global economies will take a lot of time to recover, which might be the case, but the stocks reacted in a different way. Stocks had a V-shaped recovery while the economy is still going through a recovery. So basically, investors who stayed through the course and did some intelligent investing during that point of time when that market crashed got unbelievable returns in 2020, and still is the case. So these are the four classic lessons I could take away in the year 2020, and wishing everyone a great investing year ahead for 2021. Thank you for staying with me.